Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, February 27th, 2020. Whereas for many, many months now, my focus has been primarily on the 60-minute charts, intraday time frames, looking for the levels and the developments that would trigger the next tradable pullback. And I said once we got that, if it started to get some traction, then I would turn my focus to the daily, weekly, and even monthly charts. Now, I didn't expect to turn them to the monthly charts so soon, but I'm doing that now. We're going to start out here for two reasons. Number one, tomorrow will be the last trading day of the month, February 28th. So we'll see how these monthly candles close. I always say anytime you're trading any particular time frame, it's the closing candlestick that matters. On a 60-minute chart, you want to see 60-minute close, and that helps prevent whipsaw signals. You know, if you look at this, what we'll go over here in a second is the trend indicators on here. We're going to look at just SPY and QQQ. But what we're doing, we're spanning decades here. This goes back all the way back into the 80s, and you can see the bull and bear markets. And the two things that stand out on this chart to me is like every bull and bear market, just to kind of recap if you're not familiar with this, we had a booming, similar rip-roaring bull market. They called it the dot-com bubble leading up into March of 2000, followed by a 51% or so bear market. Then we had the the housing bubble, credit bubble that led into the highs in October 2007, followed by a 57% bear market. And then, technically we've come close. Some could call that a bear market. Some say back here there were some indexes it did, but for the most part this has been a secular a very large bull market. Actually, this is a secular bull, and this is a cyclical bull within that from the 2009 lows. So what do they have in common? Well, one of the what I think is the single best indicators I like to use on the monthly chart is this 20-period EMA, and like I said, often does a phenomenal job of defining bull and bear trends. When you're below that, you can see a little bear market back here, drop of 20% or more. You're in bear market territory. When you're above it, not only does it tell you you're in a bull market, but pullbacks to that level often the 20-month moving average acts as support. And then you broke it here, and it told you get out, stay out to right here. You're in a bear market. And again, that was not all. Monthly indicators are they're gonna lag a little bit. Number one, you have to wait till the end of the month, and you can have a big drop. I mean, look at what we've had in just a week or so here. Now imagine 2 more, 3 more weeks of that, so you trigger. So that's why we use the 60-minute and the daily charts. Those get you in and out quicker, but this helps you really determine where the next trend is if you're wondering where to time to pull out of the 401ks. And so we're still above it right now. I wanted to say that. My trend line on SPY before, in the last 2 bull markets, we had some very clear uptrend lines in which to trigger, to help confirm the sell signals there. That was the 2000 top. This was the 2007 top. And now we've had a couple here, so we've really had bulls within this, smaller bulls within this larger bull. The best fit that I have, and I've had this trend line on here for a while, is this yellow trend line. I'm going to zoom in here now. So now we're just looking at the bull market off the 2009 lows. And again, this is the best fit that I have, and I've been using for a while, this trend line, which says S&P actually broke down all the way back here in 2018, and that meltdown in the 4th quarter of 2018, and has simply been back testing since. That back test is perfectly normal. Think of this no different from a swing trader trading on a 60-minute or a daily time frame. Sometimes you break down and keep going. Sometimes you break down and back test. And what's kept this back testing all along is the next one we'll get to, QQQ. But I just wanted to show you that the 20-month does a great job of defining the trends. Every now and then you'll get a whipsaw, but again, that's why you want to use the monthly candlesticks to see where you close. Sometimes you'll break down intramonth, that long wick right there, shadow on the bottom, or tail I should say. Boom, close right back on there, and a couple times here and we got close to it. One other way to look at it, I put it down here for you as well, is here's the percentage that the SPY or S&P 500 ETF, the percent trading above that, the 20-month moving average. So plain and simply, if you put a line right here at the 0 line, you already have the dotted line, that tells you when we're above or below it. And again, so you want one quick visual. If you don't like looking at the line trying to determine, well, here it is. That's pretty clear. There's the 2000 to 2003 bear market. Here's the 2007 to 2009 bear market. And the next one will almost certainly have the 20-month, or the SPY trading below the 20-month period moving average. All right, so that's it. Since I've explained it, we'll go through it a little quicker on QQQ. QQQ, I have a better trend line here. The Qs, because they're tech heavy, they were more susceptible to the boom and bust of the dot-com cycle, the dot-com bubble, I should say. And so we're just going to fast forward in here. And again, the 20-month has also done a phenomenal job at defining the trend here. And I just wanted to say, as I did the other day, we're still comfortably above it. I put the chances of us closing below that, solidly below it, at near zero tomorrow. So we're not going to have a sell signal on QQQ. We're a little closer on SPY, of course, but you want to see both indexes go. It was QQQ that held SPY up once we broke down here. Everybody jumped back in the FANG stocks, and that's been causing SPY to backtest. But same things I've been talking about for months, actually years now, just continue to build. And the longer they build, the more ominous they are, and that's these big divergences. That's what has most of these major tops, bear markets and near bear markets for decades now, have all had the same conditions. Those are the negative divergences leading up to the highs, overbought conditions, finally followed by a sell signal that comes on a break of things, trendline breaks, sometimes bearish reversal candles or multi-candlestick patterns, and of course the break below that 20-month moving average. So there it is, and try to measure it out for you. How much would QQQ have to drop just to get there? Would be about another almost 9%. And of course, maybe a little less, because as the month goes on, we'll roll into next month. So you're going to have the March candlestick over here, and so we'll call it 7-8%. But that's just to get there. And you really want to, again, we won't know until we print a solid close below there if there's a good shot that that longer-term trend indicator has triggered. But like I've been saying for a while, it's only a matter of time. It's already priced into the charts, just like this drop was on the daily and 60-minute charts. Remember, we had same conditions here on the 60 minutes when I gave a sell signal a couple weeks ago when we broke down, then back tested, and same thing back here. We had a mini flash crash back there in 2015. And that's certainly still a possibility here. We haven't had anything, we haven't had any type of flash crash, mini crash, or full-blown crash yet. We've just had a pretty impulsive sell-off. And the one word, it's really a compound word that I've used to describe this market for years now, is supersized. Just like the McDonald's, supersized meal, you get the huge fries, the half gallon of Coke, and all that good stuff with it. That is the only term I can use to describe this market, because both the length and magnitude of this bull market is much larger than previous bull markets. So therefore, you're going to have bigger corrections along the way. And finally, when the next bear market comes, it's probably going to be an outsized bear market as well. That's it. So nothing has changed technically on the monthly charts. Before I leave this screen, I want to say, subscriber posted member of the site posted a chart from someone else that showed a big bearish candle like this, red candle, and then highlighted one back from 2001. Yeah, that's great. I think it was on QQQ, could have been on SPY, but I said take a look at it, and you'll see almost identical candles throughout the years, where you see a lot of big red candles on the monthly, and they don't all mean something. A lot of times they come during an uptrend, and the uptrend just continues to go. So all I'm trying to say is right now, on the monthly chart at least, no sell signals, not even really any technical damage, to be honest with you, at least being above those trend indicators. But don't get me wrong, again, if we didn't have these divergences, I'd say I would be saying, well, it means very, very little. It certainly means something with this magnitude of the drop that we've had recently, coming on the heels of these divergences and on the sell signals on the daily and even weekly charts. Let's get to those now, and we'll go through this a little quicker as we drill down on the time frames. QQQ on the weekly, I have several different trend lines. I'm just going to focus here on this trend line. We had a minor trend line here, and probably this is to me a little bit more significant. This trend line right here comes off the lows. Remember, we bottomed back on Christmas Eve 2018. I believe that was it. The week ending, yeah, the week ended February or December 28th, and that was a pretty important trend line. It was taken out today, and so we can rally up tomorrow and get back on it, and that'd be about a 5% rally. Anything's possible, but right now we're below that trend line. We took out this one that started the sell signal. That was the one on the daily we're watching, and we're coming up on the 200-day moving average, which usually does a pretty good job. If you turn everything off here and turn that on, you're going to see it say 40 period, because I'm on a weekly chart. There are 5 days in a week, so a 40 period a moving average on the weekly is the same as a 200 day on the daily, or a 200 period on the daily. So that's it. And yeah, there are times you chop through it, but a lot of traders tend to step in and buy the 200. So I'm still leaning towards a bounce next week. I was leaning for one today, took a shot at the Qs, took a 1.6% loss. That was the first official trade we've added in many months, and we stepped in, and I kept stops very, very tight on that. I had an extremely favorable risk reward because, as I said at the time, it was a catch a fallen knife trade. We either needed to bounce from where we did today. We broke out of some 1 minute trend lines. Those breakouts should have stuck, but they didn't, and that's why I had to stop not too far below. And we also hit some support on SPY, which I'm going to get to in a second. We bounced, went down, closed a little bit below it. Maybe just kind of late day margin call selling, but here's what we have to watch now. Again, we're going back several years here, and you can see for the most part, when you're in an uptrend, the 200-day moving average does a great job of acting as support on pullbacks, particularly orderly pullbacks. When you break it, there's sometimes a lot more to go, especially a solid close below it. We're still above it right now. So based on this, yeah, ugly selling, but we're still above the 200. And usually when you haven't tested in a while, you're going to get at least a little reaction there. We bounced, we hit it there the first week, second week, third week, finally broke below it the third week, and once we're under it, then it becomes resistance. That's the thing. Just like trend lines and price support and resistance levels, as I always say, support once broken, boom, then becomes resistance from below. So right now we're coming up on support again, that key 200, and you can look at it here. It's all these years, and there's the big corrections. That's when you trade under it quite a bit. So if we get under it, print a solid weekly close, especially 2 weekly closes under it, then you want to start looking for that as a potential resistance level, and recognize that the trend, at least on this time frame, is bearish. But we're not there yet, and so let's look at SPY, see where we're at there. SPY, we did cut through it. QQQ, and I noticed it's the tech-heavy stocks, Apple, QQQ, the 200 EMA is the one I like to use, and the 40-week EMA, that means exponential moving average. Some people use a simple. It does a little bit better job, as you can see here on QQQ, than SPY. But it is worth noting, SPY also quite a bit. You'll see traders come in and buy pullbacks to the 200, our 40-week moving average here on the weekly chart, and they took it out with conviction today. But guess what? The 40-week is just that. It is a weekly. We're on a weekly time frame right here. And so you want to know what I think happens? Rarely do you just come on right through there and keep going. Like I said, here was a big sharp down week. You hit it and you consolidated on it the following week. And there was actually a snapback rally after you overshot it. So remember, this is a weekly candle. This candle doesn't print until tomorrow, finalized at 4 p.m. Friday. This was a big intra-week drop below. We snap back. Here's another intra-week break. We snap back. So there's a good shot that we snap back tomorrow to close back on or around that level. We'll see. If we don't, if we print something down here or even larger, you still have QQQ that has to give way, but those are things you want to look for. If we go much lower, the dam breaks usually. Markets, orderly sell-offs, yes, more often you're going to see the pullbacks and buyers step in at these levels. It's the very impulsive sell-offs. We haven't seen one this impulsive in quite a while. And when I say the market breaks, it means, it probably, undoubtedly caught a lot of longs off guard. and more importantly, those big institutional investors, hedge funds, pension plans, things like that, that have to scramble. They can't use hope and pray like the retail investor, pray and hold and hope things come back. They have to manage risk. They have to cut losses. They have to hedge up. They have to buy put protection, or short other instruments that are going to balance out, or just outright sell, reduce long exposure, and then selling begets more selling. So that's where we're at. Okay, let's put back on the trend lines. A couple other things to note is we had look at this, a bearish crossover on the weekly already. Remember just a few days ago, early this week, I pointed out the bearish crossovers on QQQ and SPY on the daily time frame. We already have one here on the weekly, but we'll see how this ends. We have to see how the week ends. It's just starting to cross, and we're coming off that oversold. And that's another thing I pointed out recently. See that 82 level right here, the red line? I mentioned that we were recently at extreme overbought conditions on QQQ on the weekly chart. Last time we were this overbought was right here, and in just what was that, 2 weeks, the Qs dropped from top to bottom, fell 12.5%. If I did that right, if I grab the top of the candle there and the bottom of that one, yeah, about 12.5 from the green candle. And look at that, perfect kiss of the 200-day moving average, and then we rallied from there. So this is similar. It's a little bit bigger drop. When I said 12.5 back then, and here from the top so far, and we can't say it's over yet, 13.5. So really not much different than right back here. And like I said, the similarities also, we had that extreme overbought reading up to the 82 level. Normally anything 70 or above is considered, that's an orange line on the RSI, considered overbought. And we hit that 82 level like we did back there. Hit it there and it didn't really do much. We did actually correct for about a month actually. But this one was a little sharper. And again, this one ran right into the 200. Okay, so those are the levels to watch. 200 price support. I'll give it to you right here. You'll probably see it on the daily chart when we get there in a second, but we have some levels down here on QQQ, and we still have, it's been my long-term target since 2018. I think we're going to get there, but we need to, the way it works is you have to take out the support levels. You have to flip these trend indicators to bearish. This isn't a swing target, it's a trend target when the longer-term trend indicators break. And right now, so I just got finished showing you monthly and weekly charts. For the most part, they're still intact. Now we drop down to the daily time frame. We've got a lot of different boards. Let me show you this one here. This is probably most relevant. On the daily time frame, I've been harping for many weeks now on the trend line off the October 3rd lows. That was, to me, the most significant level. We got once it broke on the 60-minute, we had the sell signal triggered, broke here on the daily as well. And so here's the picture, or the bigger picture on the daily. We had negative divergence right there at that high. There's RSI divergence, and we started moving lower. We gapped down, and here we're at, let me go back to this other board here because I have different levels. There's this other potential trend line that comes in right here. And let's turn off all the other lines and draw that out for you. Why did I just call it a potential trend line? Well, in my opinion, it takes 3 reactions. We hit it here, but there's no reaction. You can go through it. A reaction is either we consolidate, trade on it for a little while, or a bounce. That's what I consider a reaction. And I say that because any 2 points can be connected at random. So for me, I want to see 3 reactions. But because it's a pretty significant reaction low back here, that October or December 24th, 2018 low, this reaction low, I think the odds are good. So let's see what happens. And by a reaction, we can overshoot it tomorrow. Let's say we gap down, kiss the 200-day moving average, which is right here, the red line. Again, just like the 40-week I was showing you on the weekly charts, the same moving average. And you can see, again, where buyers like to step in and buy. Sometimes when you have a big sell-off, you have that downward momentum or velocity. I call it a momentum-fueled overshoot. You overshoot the resistance or support level that's going to hold and does hold, but you just overshoot it briefly because you had that velocity heading down there. I use the analogy like a pitcher throwing a 90+ mile-an-hour fastball. Catcher's glove is going to stop there, stop hard, and stop that ball. The glove is going to snap back a little. His wrist is going to snap back, and then it's going to come back forward. And that's kind of what these momentum fueled overshoots are. Same thing to the upside. They pop above it. Rejection on the 200. Finally got above it, broke above it, back tested, and that was it. So there it is. There's your support levels to watch. Ppo Trend Indicator is still bullish for now. That's one trend indicator I like to use. The 9 EMA, the white line. When that line, the white line is the last of the two to cross, and when it does, it tells you the trend is bearish, and like it did there. And when the white line is above, there are some whipsaw signals, but for the most part, when the white line is above, the trend is bullish, and so it still is right now. So yes, ugly, but right now, long-term trend indicators nearly across the board are still intact, and so I'm looking for a bounce here. I was looking for a bounce yesterday, didn't materialize, no big deal. Get out, get back in, jump back in today, and that's all I can do on these levels. Just like on the way up, you can look for sell signals and resistance levels to short into or to go long in a breakout. On the way down, when the market drops, QQQ drops in just a week or so, falls 14%. If you're looking to short here, you're going to get burned when the tide finally turns and the algos start buying. There's some big support coming up down there, and we could take it out. There's that trend line I just showed you. We closed right about on it, a hair below it, and there's not really any solid support until we get down to about that 193.68 level right there. So that is a pretty key level on QQQ. If we if we happen to head lower without a tradable rally before then, we're already oversold right now. Last time we were oversold was here. Time before that was right here. We got almost down to the 70 level. We didn't get below it. These two were below it, and we're below it now. We were below it right there. So you do the math if you want to short. You look at this and decide if you'd rather be looking to short or go long here. And that's why I'm more concerned at this point. I've caught plenty of that on the way down short, and now I'm more interested in catching the first snapback rally when the algos go the other way, when they flip that switch from buy to sell. And what it's going to take, it's right now, in my opinion, is simply margin call unwinding and people panicking longs. Everybody, I think the coronavirus is certainly a serious thing. Don't get me wrong, but I think it's a little bit overblown. Let's say there are some more supply disruptions, and some more companies revise down guidance. Okay, well, is a 14% drop? Are their earnings going to drop 14%? You have to ask how much of the worst case scenario for the coronavirus, or the most likely worst case scenario. I won't go to full-blown Armageddon here, but how much of the of that is probably priced into that 14% drop? And I have to say quite a bit. So there it is. And the thing is, here's the levels. We have trendline support here, 200-day just below, and then below that, if things get really ugly, another maybe almost 6% drop down to the 193.68 level, and that is big support. Why is it big support? That was a key level for a long time. QQQ was tapping on that level, finally took it out, and since then it really never looked back until now. So that was a breakout, a very significant breakout. Resistance once broken becomes support. So and even the other day, I was looking for a bounce. I said I'm only looking for a near-term tradable bounce, and we did. We got one yesterday. Remember, we hit that level on the futures and on QQQ, and we bounced right up to a target there. That was for today's trade. That's the one we took a pot shot on here, stopped out there, 1.6% loss, and I'll do it again tomorrow if I see an opportunity, by the way, which be a break above this trend line here, this price channel, possibly. We'll see what happens. Maybe a pullback to another key support level, and look for some type of reversal. But let's look at SPY. Let's see if there's, before I leave QQQ, we have the potential divergence forming here still. It's not been taken out. The RSI down here, which I'm drawing right now, positive divergence. So I just move the hash mark here. It's like football. the team gets first down. The line judge moves, or the guys holding the first down markers, they're going to move the markers forward, and that's what we do with this divergence as long as it's intact. The RSI divergence look like it may burn through here, but we still have, or the PPO divergence still have the RSI divergence intact. And let's see what we have on SPY. Nope, they burned through the PPO divergence, but they still have the RSI divergence, so clinging on by a thread. Let's walk back on SPY a little bit. I'll give you some levels. Nope, 60-minute chart's a mess. Again, I'm turning out now and moving my focus to the daily chart. So here's what I see on SPY. These were all support levels that were taken out on the way down. Here's the one we were at yesterday in the 200. The 200, as I said, didn't hold. And you can see when it gave way, boom, SPY moved down through there. So I'm not going to try to spin that as anything but bearish when the 200's taken out. We were here all day, and that's where we stepped in. That's where I thought we might get a bounce, because this was very comparable to that breakout in QQQ. Remember I just showed you on the daily? SPY had these two highs. They were both divergent highs, led to corrections. We got them both. And then finally it went on to break out there, and that was the breakout. Came back in, and it did pause there today quite a bit. It was 302.46. Remember, we had these 1 minute downtrend lines. These broke, and that was part of the reason for jumping in long earlier. We broke out here, and then we came and back tested, and that's why I had to stop a little below, because if that back test failed, which it did, the breakout failed. SPY never managed to, took out this trend line, but then the seller stepped in, and boom, that's where we're at. But what I was getting at is this consolidation, most of the day it held or tried to hold that level, and only late in the session did it give way, that 302.46 level. So that is bearish right there, because that's support broken, and that opens the door for a move down to the next target or support about 294. 294 breaks, then we have to turn our focus to some of these other levels here. But again, not good for SPY unless tomorrow is a green day and we rally, which I think there's a decent chance for that. I'm sure we'll get some kind of tweet, something come overnight, try to prop the markets up. But if not, a little more downside. And again, we're getting the rubber band is very stretched. The RSI on SPY is 2024. This is the 30 level right there. That's the last couple times we were oversold. You can see we bounced. Is this something different? May prove to be. I always caution you, oversold is not a buy signal. Divergences are not a buy signal or a sell signal. If they're positive divergence, they're not a buy signal. If they're negative divergence, they're not a sell signal. They're indications to be on the heads up, be on the lookout, give you a heads up, that is, of a trend reversal, and then you just have to throw in, of course, the sell signals that trigger that. That was, zoom all the way here, and there was, actually I can't even work with this 60-minute chart now. This drop, there's a divergent high, was so big because of this move down. When I roll and try to scroll in here and show you the wedge that broke down and put up that marginal new high, the drop is too big. It's just compressing the chart here. Same thing on, QQQ, we can see it a little better. It's showing better there. Again, same stuff I was talking about on the weeklies and the monthly charts. There was your divergent high, there was your wedge breakdown back test, pushed up, made a marginal new high, but it did not negate or take out the divergences, only extended them and made them larger, setting the stage for what we're in right now. And that's it. So I've given you levels to watch. 28 minutes. Let me see if there's anything else I want to cover. Yes, if I can do this in 3 minutes, I'll rifle through the 11 sectors in the S&P 500. As I do this, keep in mind on my watch list, I have them sorted by weighting by far. So when I get to the end, I might even cut it off, utilities, basic materials, they're not going to move the needle. They can rally 20% tomorrow. They're not going to move the market. This is what moves the market. And then as I go down the line, you'll see the weighting. So XLK tech, as I always say and often say and said it many times, and I said it right here back then in 2018, and I was saying it here, when tech breaks, the market will break. And then when it broke, I said tech broke, major sell signal in the market, we dropped 25%. Back here, tech broke right there it is. And so when tech broke, the market broke, because the market is tech. due to the nearly 1/4 weighting. All right. Ugly chart. Here's the trend line that I have. That's been taken out today. I don't see a whole lot of support until you have the 200-day and then 82.69. That was this level here we broke out. There's XLK. Doesn't look good. I just want to say that I can't spin it as anything but bearish, but there are some support levels to watch coming up, and 200-day comes in at about less than 2% below, and then the that 82.70ish about 5.76. Skipped one there by mistake. XLV healthcare. This is about a 14% weighting. Pretty solid support it's coming up on. It has a support zone. This line here, there's your support zone. So healthcare, the correction was certainly priced in with the divergent high and the breakdowns, all that, but I think it's a little overdone. So you're looking to bounce sooner or later, and trend line support a little bit below. So there's your what I think to be the maximum near-term downside. And again, this looks like the initial leg down and most likely a deeper correction to come. But for now, we're getting very close to a bounce. XLF. There's a support line. We were at support yesterday. I pointed that out, I believe. Boom, we gave it up. And that's why this was such an impulsive move today. All these support levels where the market should have bounced, where the buyer should have stepped in, they didn't. Right now, this market is in distribution mode. Well, that'll continue until it doesn't. When it doesn't, then it goes the other way. The algos flip from sell to buy, and then you get a sharp snapback rally. It'll probably be 6% or more in just a couple days. So that's why I'm willing to take those shots on it. XLC doesn't look good. Support 51.72 and the 200-day sliced right through. Week's not over, so maybe we snap back tomorrow. And if not, ugly looking chart. I don't have really solid support down there at about 47.77. XLY, same story here. It's just a bloodbath of a sell-off. Took out this trend line, kind of cut through it like a hot knife through butter, as well as at 124.44 support. I mean, like I said, these are levels that dip buyers should have stepped in. These were key support levels, and we went through them like they weren't even there. So all I can tell you right now is I don't have a decent, really solid support down here until about 113.65. So we're kind of in no man's land. Tomorrow they can snap it back. They have the chance to close the week back above that 1935. So we'll see what happens. If not, that should open the door for a continued move down. XLI, here's a support level right here, trend line with support about 73.18. We're getting now down to about a 9% weighting. This is the industrials, by the way. And XLP, wow, ugly, ugly, ugly. Right down through support, second support, 200-day, and it's not a hard line, but I don't have a whole lot of support here on this one. A lot of these sectors these sectors have broken down, and they're in what I call no man's land right now, smack between support and resistance. Those former support levels. Energy is just falling off a cliff. There's XLE. Obviously doesn't look good. And then XLU, like I said, you get down here 3% weighting. It's at support. And these are utilities. These are usually what investors flock to during times of, especially if the economic outlook starts to pare down, which I'm sure it is. I'm sure that's part of the coronavirus scare here. So there's probably a trade to be made here if you want to step in, especially if you like dividends, safe kind of stocks. XLU, you can buy it at the trendline support. 200 I don't put a lot of weighting on here because you can see it really hasn't touched the 200 in a while. Sliced through it there. Like I said, the 200-day works better on tech stocks and tech-heavy indexes like QQQ. If it takes that trend line out, next support here 61.18. Let's wrap it up here. The only other two are real estate and basic materials, and they're not going to really move the needle in the market. So we'll wrap it up here, pick it up tomorrow. And this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.